I'm going to assume you're like me and take this as a very, very serious endeavor, and that you want to make sure that even if you do something stupid and get killed, that your child will be okay. So you need a will, you need a living trust. You need both of them. Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And today, I'd like to begin, as I always do, pointing your direction at wealthformula.com. Lots of resources there. It is where this podcast is hosted. It is an opportunity for you to potentially get on some of our lists, including the Accredited Investor Club. The Accredited Investor Club is for accredited investors. Accredited investor, what is that? It's just either you are one or you're not. It's about how much money you make or how much you have. $300,000 if you're filing jointly, $200,000 a year if you file by yourself, or a net worth of $1 million outside of your personal residence. If that's you, that means you are an accredited investor and you can join the club. The club is for free. It's sort of like a badge of honor, really, if you think about it. You know, it's like a private club only for those of us who meet that criteria. So the rest of you, I'm sorry. So for today's show, I got to tell you the backstory here. I realized I hadn't done one of these Ask Buck shows in some time. And so looked for some questions, found a few questions, and I found the first one was a question that had just an enormous answer. So this podcast is really just answering one question. And it's an important one because I think it's for basically people who are just kind of starting out, especially for those who are high-paid professionals who went through a lot of school. For example, you're a doctor, right? You are, say, any kind of professional. You're, a lawyer. You went to business school after a few years in the workforce, and now suddenly you're making more money than you had before. That's very common, right? It's very common to have these situations where, because you've gone to school for a longer period of time, you start making money later as well. So, the situation is not an uncommon one for highly educated, high-paid professionals. And we are going to just address that question with enormously elongated answer when we come back from these messages. Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com. Okay, here we go. Here's the question that ended up having me think. I was like, this is just one show. This is one show. Okay? So this one is from Jesse. Here is Jesse's question. Hey, Buck, thanks for all you do. I am a 30-year-old guy. Just finished my internal medicine residency a year ago. Started making some money for the first time. Salary around $300K. I'm married with a 3-month-old baby. My wife is a nurse, but she's been taking time off right now. Haven't bought a house yet. Renting and figuring out things. I live right outside of Houston. It sounds like your story is somewhat similar. What advice would you have for someone like me? Okay, that is a fantastic question. Okay, it's a fantastic question. It's a very long answer you're going to get. First of all, yeah, I was very similar to you, and I was like 33 when I got out of training. I think you said you were 1 year out of training, and maybe you finished when you were 29, so it makes sense. I was doing some surgical stuff. You're an internist. One caveat, which is I went off the deep end into the entrepreneurial world, and I'm going to answer this considering that you are more sane than me and that you'll keep using the education that you had and continue being a physician. So that's the context I'm going to use. But anyway, the reason I like this question is the reason I started this podcast in the very first place when I finished training is I didn't know what to do either. I was looking for someone to give me some kind of advice, and I talked to other doctors, other surgeons. But I've told you the story. Especially when it comes to things like, permanent life insurance, wealth formula banking, all that kind of stuff. I've told you this story before where it's pretty clear that they had no idea what they were doing, no idea what they were talking about, even though I will say this, doctors act like they know a lot more than they do about everything as a general rule. We can convince people of that. For some reason, it's like, you do well in school, you knew a lot for tests and stuff like that, and you assume that you know a lot about everything. And that is what gets a lot of doctors in trouble financially, by the way. Anyway, what I did was I accidentally read a Robert Kiyosaki book called The Cash Flow Quadrant, and that sent me down this rabbit hole. I call it the purple pill. I recommend that book. I know some people have mixed feelings about Robert Kiyosaki. His work has been very influential on me, at least his books have. And so I would recommend that. And that took me down this rabbit hole where I ended up doing as much research as I could, trying to figure out like what this other way that rich people, wealthy people seem to view personal finance, because it was pretty clear to me that there was another way. There was like different lanes for different levels of wealth, and that the high paid professionals that I was around, they weren't doing much differently from the poor and middle class, frankly. And then there was all these people making a lot more money who seemed to have these secrets. Well, I wanted to know what those secrets were. And that's why I went digging around and I found what I think is a lot of really good information. And then at the end of the day, that became the core message of my podcast, is sort of like bringing that out to everybody else. Now, since then, we've gotten into a lot of macroeconomic type things, talk a lot about different topics, just trying to keep people, educated in general of what's going on in the financial world with different types of asset classes and stuff like that. But I do think it's a very useful topic to come back to in general. Like, what do you do, right? So I'm going to take a shot at this. And it is, again, it's a long answer with multiple parts. Okay, so first and foremost, the first thing I would do, check with your financial advisor, because he knows more than me, apparently, because he went to some 6-month certificate program. But I'm just giving you my perspective of, all the years I've been at it here. Okay, so first and foremost, you've taken on the responsibility of parenthood. Okay, I'm going to assume you're like me and take this as a very, very serious endeavor, and that you want to make sure that even if you do something stupid and get killed, that your child will be okay. So right now, you don't have the money to do that unless you are independently wealthy. And so you need to be thinking about life insurance. And that's where I start. Now, we just had a show on life insurance. We've had a bunch of shows. And then there's wealthformulabanking.com. You can also go to episode 494. Again, that was a recent one where people from this show, people who watched the show, were talking about some of their experiences with different types of permanent life insurance. But bottom line, in my opinion, you have to make sure your baby is taken care of if something happens to you. And so whatever you do, life insurance is what you have to think about. Now, in my case, I have both what we call life insurance retirement policies. The Wealth Accelerator is in that category. Wealth Formula Banking sort of in that category as well. But I also have a ton of what's called convertible term insurance, which is essentially like cheap term insurance, right? But the reason it's called convertible is at any given time, you can convert it into permanent insurance without getting your health checked again. So, for example, when I started this podcast, I was in my late 30s. And believe it or not, I am now in my, early 50s. Don't tell anyone, but that's true. Actually, I've convinced my children that I'm in my 40s. So the fact that I got these convertible term means that, when I want to go back and potentially get permanent life insurance, I use the underwriting of the late 30s me. Anyway, I would highly recommend that because, again, especially if you are interested in some of these, permanent life insurance strategies we've been talking about, one of the nice things is you will grow wealth. And so your numbers in your head and what your perspective is going to change, and what you think you should be leaving for your children may change, and what you think about, a wealth accelerator type program and the type of income you need may change, but your health definitely will change because you're just going to be older. So trying to lock in your health now, convertible life insurance would be a nice piece to add. So those are the things that I recommend to think about first. Bottom line is life insurance, protect your family. Now, as long as we're on the, life, you accidentally dying kind of situation, this isn't just accidental death, but this is in general, this is something that you really need to have, is you need to have a will and a living trust. Okay. Now, people talk about wills all the time, but a will alone will not keep your estate from something called probate. You may have heard of what probate is. It's a legal process that happens after, someone dies. And basically it starts by proving that the will is real, then involves gathering the person's assets, paying off debts and taxes, and finally handing over the remaining property to the rightful heirs. Now, that whole process can take several months to a year, sometimes longer. And the cost, like court fees and legal, can actually make a really significant, they can take a really big chunk of the estate's value. Now, imagine you've got a grieving wife, a child who's lost their father, in your case, and they can't even access the money, your money, right? That's what happens if you do not have a living will. It's cheap, get it done. So you need a will, you need a living trust. You need both of them. I'd also make sure you have as much personal liability insurance as you can, including umbrella insurance. Now, this is really cheap stuff, and this is going into, asset protection, right? It's cheap. You just never know when you might get into like a fender bender and hurt someone, or even if your kid, gets in a fender bender and hurt somebody later on when that baby's a little bit older. When you talk about asset protection, since we're on that topic, and we start thinking about potentially investing in that kind of thing, I would get a manager-managed LLC in a state with favorable corporate protections, like, say, Wyoming, Nevada, Arizona. There's other ones too. Yeah, but anyway, those are the ones typically I've used in the past. And I would do all of your investments through this. Why is that important? In short, it makes it harder for creditors to get your assets. Now, if you have, by the way, an LLC, and it's a California LLC, it's not going to make it harder for your creditors to get your assets, because there's something called charging order laws. Basically, it's how easy it is for the corporate veil to get pierced. And in California, it is a meaningless, it's really easy to get through that LLC into your assets. It's not in other states like the ones I mentioned. Now, the other thing I mentioned about that LLC that you might have wondered what it was is I said a manager managed LLC. Okay. And what that means is that it's not the members, like the owners, who are managing. It's a manager, and that manager can be and should be you. But the owner of the LLC, the membership, should be your living trust. Okay? I hope that's not getting confusing. But you're going to have an LLC where the member, or the owner basically, is your living trust, or your living trust and your wife's living trust, or whatever. And then you are going to have yourself as the manager. So that's obviously important to have the structure from the ownership side, because of, again, what we just talked about. You don't want to have that LLC end up in probate either. The reason I like the manager managed LLC is you're going to stay manager of this thing, period. Okay. You, or your wife or whatever. But as your estate grows, you may want the ownership of that LLC to change from your living trust, which is a great estate planning tool, maybe something more robust with a lot more asset protection, a lot more, other protections, like, for example, Doug Lodmel's Bridge Trust, or a pure offshore trust. And if you do that, all you're going to do is transfer the ownership of that LLC off to that trust, and you're still the manager, though. You see, that's why I do a manager manage LLC. Then you just change ownership when you get more sophisticated. That's probably enough for you on just asset protection. I've given you a bunch. If you want more, go to episode 463. There's actually a bunch of asset protection shows. There's a bunch of times that Doug's been on. In particular, Doug's the guy I like. I've interviewed a bunch of people. A lot of them don't make any sense to me. Doug makes a lot of sense to me. So Doug Lodmell, asset protection. Okay. Now, as your estate grows, you have to worry not only about asset protection, but also estate taxes, right? So basically the government has this thing where they you've been successful, you make a bunch of money, they want to kick you on the way out as well. And so they tax your estate after it hits a certain amount. Right now, that number I think is it's around 10 million plus for an individual. If you're married, it's like 20 million. It's going to go down for sure. So what I would say is, for those of you who are anticipating having estates of, $10 million or greater, which I would say, listen, it's in your case, Jesse, this is probably you. It sounds like a lot of money, but you have a lot of life to live, a lot of earning to do. And so this very well could be you. Okay, 10 million. And the reason I say that is I think the estate tax laws are going to, they're going to come down. In other words, the limit that they set, or I shouldn't say the limit, the threshold of 20 million and 10 million, like I just mentioned, is going to be a lot lower in the future, just because of, what we've seen happen in terms of the government spending and deficits and all that mumbo jumbo. And the Democrats will ultimately be in power again, and they always try to bring it down. And Bernie Sanders wants it to be like 2.5 million or 2 million or something really low. This is stuff that's not necessarily going to be relevant to you now, because again, you have a while before you get to those kinds of wealth problems, right? But as your estate grows, you have to worry, again, not only about asset protection, but also estate taxes. And when you get to those higher levels of net worth, you're going to really start to need to be thinking about more sophisticated planning, like dynasty trusts and family trusts, which you don't need to worry about right now. But that is something that you should be thinking about. And if there's those of you who are, you're in the thick of your career and you haven't done that by now, it might not be a bad idea to start thinking about some of those things as well. So now everything I've told you about up to this point is very defensive. In other words, this is all about you're getting insurance, your asset protection, estate taxes, so you can mitigate taxes when you die. There's also estate planning stuff that we talked about with wills and trusts. So what about, the stuff that gets people more excited, like investing? Well, that becomes more of a personal investment philosophy to a certain degree. Obviously, I've chosen alternative assets, especially real estate. And I would say on that front, when I think about it, if I had to do it over again, I don't know that I would be 90% real estate. I might be more like 60% real estate. Now, don't get me wrong. Okay. Real estate has been very good to me over the long term, right? I've been an investor in real estate since 2009, but the one thing I've always kind of hated about real estate is that you often find yourself not liquid when you are like hardcore, that's all you do. All your investments are real estate. And there are times when you really want to have some cash around. For example, in the case of the real estate market that is getting hammered like it is right now, it would be nice to have a bunch of cash sitting around and deploying it, right? Or some other business opportunity that comes along that's capital intensive, or just needs some bucks and you might want to have some. You get sitting in stocks, you might be able to take it out and just do that. You can't necessarily do that if you're all real estate. So those are good reasons. Of course, there's also the reality that sometimes, times get tough and you need some cash. Life happens. I've had my butt kicked more than once. And in those situations, again, if your money is in real estate is not liquid. I doubt that you were planning on going 90% real estate like me anyway, but I would say that I would probably err on the side of having a little bit more liquidity. It's funny because I actually heard video. Somebody asked Donald Trump what he would do, what advice he would give to younger people. And he said, oh, it's good to have some cash. So, I think all real estate people have that, but that's pretty theoretical. Let me give you some more granular stuff. Okay. As far as your living situation, you're renting. Would I go out and buy a house right now? No, I wouldn't. I'd continue to rent for a while instead of locking up a bunch of your investable assets in a house. There's plenty of time for that. And frankly, your baby is not going to be able to tell the difference right now anyway. So locking up that capital early on is going to slow down your ability to grow wealth. So I think renting is actually not a bad idea at all at the beginning. Now, when you do buy a home, though, don't buy something that's going to stress you out as a mortgage payment. Again, there's plenty of time to buy that, great, big, beautiful house later, but try to live within your means on the big things like mortgages, that kind of thing. And that actually brings me to another topic that I've gone back and forth on myself. Is it better, when possible, to own your house outright or have a mortgage? So I would say theoretically, I would tell you that it's better to have a mortgage. Why? Well, first of all, any debt on your house is asset protection. If you have a ton of equity in your house, you will necessarily make it a big target for creditors. Also, the cost of interest on a mortgage is typically less than the returns you can make if you invest that money elsewhere. Okay? So those are the arguments I would say, and again, theoretically, those are the reasons you should have a mortgage. Not you, but I'm saying in general. Those are the arguments for having a mortgage. Theoretically, the math makes sense. But again, I would say that this is a more challenging issue. Personally, I have a mortgage for all the reasons I said. But, psychologically, I'd prefer not to have one. It's good to feel like you don't need to pay to stay in your house. Now, if you do end up having a house that's paid off, you probably are pretty well off financially. You probably should consider a family trust or dynasty trust and, get some of that real estate in there, and try to mitigate the creditor risk as much as possible. Well, I guess we should touch on investing since we talk a lot about that on the show. And the biggest thing, in my opinion, is start early, be consistent. Keep putting money into investments over time. You're going to be grateful that you did. And of course, as far as what to invest in, you're going to have your own personal investment philosophy. Obviously, mine has revolved around real estate. And if you want to know why and whether you should think about it, well, there's a couple reasons for that. First, it's what I know. I come from a real estate family, and it's something I never was scared of, and I kind of understood it. My dad does it. He still does it. He's 85, maybe even 86 years old. He does it, and the thing about my dad is, he's always, not always, but almost always over the last 50 years, has made money in real estate. Like clockwork, he's tried anything else, he's lost money. Now, I won't say that he hasn't lost money in real estate. He does, and everybody is going to lose money in investments. It's just going to happen. It's going to happen, and just be prepared for it. You're in a situation now where you didn't really have any money to lose. I was the same way in 2008. 2008 came, I didn't really have any money anyway. It didn't touch me. But you're in a situation right now, you probably didn't have money to lose. You're going to lose money at some point. Just be prepared. But my dad, who has really, made his life from real estate, he lost money in real estate too. Like in the 90s, interest rates went rapidly high, Alan Greenspan days. And then there was the mortgage meltdown in 2008. He lost money there. He's been doing that for 50 years, and his wins have way outweighed his losses. And that's what investing is all about. Now, the other reason I'm a real estate investor, though, is a very practical one, and probably something you should consider. I want to pay lower taxes. Now, I have a special designation, which you may have heard of, maybe not. It's an IRS designation on my tax return, where I'm a real estate professional. And it just means that I spend over 750 hours per year in the business of real estate investing. I don't have a vocation that I spend more time than that. So what's a big deal about this? Well, it's kind of the holy grail for legal tax mitigation, right? Let me try to explain how it works. The funny thing about real estate is that even though it tends to go up in value, investment real estate is seen as something that depreciates over time by the IRS. Again, it actually goes up. The IRS marks it down as something that loses value over time. It depreciates. So Say you buy a duplex, even though that duplex may be going up in value every year, you're allowed to take losses on depreciation on your taxes. In this case, with residential real estate, the value at which you bought the property is evenly divided in terms of depreciation over 27 and a half years, straight line depreciation. Now, that's usually enough to cover cash flow from a property and making that cash flow tax-free. Of course, you also have mortgage interest, which is also deductible. So often, it is frequently the case that cash flow from real estate is tax-free. Now, there are things you can do to speed up that depreciation. That's normally 27 and a half year straight line. For example, you can do something called a cost segregation analysis on a property. This is actually an engineering study. And what it does is it separates your property into two things: real property, which is what you think of as real estate. I mean, you got the foundation and all that stuff. And then you have the stuff that is considered personal property, which is stuff you can kind of rip out of the house and throw out on the front lawn, like cabinets, appliances, things like that. While real property, as we mentioned, depreciates at 27 and a half years, personal property depreciates over 5 years. So all of a sudden, if you do one of these engineering studies, a portion of your property can have much more rapid deductions over those first 5 years of owning a property. That's classically what the cost seg study does. Now, what was crazy was when the Trump tax plan was first put into place in his first administration, and he had a way for people to accelerate the depreciation even more. What he did is he allowed you to take that personal property and rather than depreciate it over 5 years, put it all in the first year. And that was incredible. Why? So let's do a little bit of math here. Say your duplex costs $1 million. You put down $250,000 as a down payment. Then you took out a loan for what? The remaining part, $750,000. So your down payment is $250,000. Now, after you buy this property, you do a cost segregation analysis. And lo and behold, it comes out as 30% personal property and 70% real property. That, by the way, is pretty typical from my experience. So now you have a $300,000 deduction in the first year on that property that you can put on your tax return. But wait, you only put in $250,000. So literally, you actually got a bigger deduction than even the money you put in. So basically, the government is kind of paying you to invest in real estate. Now, all this sounds great except one little problem, and that is normally real estate losses are considered passive losses, and they can only offset passive income. Your income from that property, of course, is passive, but you can't use those losses against your active W-2 income. And that's, in your case, Jesse, is what you got. Actually, you used to be able to do that before Reagan changed the law in the 80s. And that's why doctors used to own a ton of apartment buildings and stuff. It was like they were all dilapidated because they didn't really care about them. They were using them for depreciation. And there was a mass selling in the 1980s when that law changed. But now you can only use these losses against other passive income. So depreciation losses are passive losses. They can only be used against other passive income, which might be ownership in, say, a surgery center. If you own stuff and you're getting some income from that, obviously you're not, even if you operate there, it's not like you're working there or whatever. That could potentially be passive income. A GI lab or dialysis center, same thing. The bottom line is, if you are passively collecting income, you could use some of those passive real estate depreciation losses against that. Now, there is another situation in which you may benefit, which doesn't necessarily require you to have all that much passive income. Let's say, for example, your wife who's staying home, she's nursed right now, decides that, you know what, I ain't put nursing on hold. I'm going to become a real estate professional by IRS designation. If you did this, things would change dramatically. So in order to qualify for that designation, she would need to do 750 hours or more per year in investment real estate work. And that doesn't mean being a real estate agent. It means basically you don't even have to have a real estate license. You basically just need to be working on your own real estate and have no career where you work more than that 750 hours where she works real estate. Now, suddenly, if that is the case, now, if she is a real estate professional, if she buys real estate because she is a real estate professional, her losses, her passive losses become activated. They become active losses, meaning they can offset any kind of income. And if you're filing jointly, guess what happens? Those activated losses would be able to be used against any of your active W-2 income. That is, I think the limit now is $500,000, up to $500,000. Now, in your case, obviously, that would mean a huge tax return. Okay, so you get the idea. Being a real estate professional or having your wife as one is a huge tax advantage. In fact, we have had listeners make the calculated decision to have their spouse who's making less money leave their current career and focus on real estate for this purpose alone. So this is something you could possibly do. I'm not saying you should, but I'm just throwing ideas out there. Now, if not, okay, there is another way to get activated losses to real estate. And this is, I wish more people would know about, and I don't do it myself, but it's a great idea. You could get into short-term rentals. Now, if you follow the IRS laws and short-term rentals and managing them on your own, you can get the same benefit of activated losses from owning and operating short-term rentals, like the VRBO and all that kind of stuff, without the real estate professional designation. Now, if I were you, Jesse, personally, I would seriously consider that because, especially if your wife is no interest in being the real estate professional here. I would seriously consider that because the depreciation alone on something that, if you do a cost segregation analysis and take bonus depreciation, would be an immediate ROI. Anyway, hey, listen, I am going on, and I told you that's why I can only answer this one question because there's so much here. Okay, but I'm going to give you one more thing that I wish I did more of when I first started out. I wish I had consistently from the beginning taken maybe 5, maybe up to 10% of my investment portfolio for what I call asymmetric risk type investments. This could be angel investing, right? I really wish I'd done that. Startups, I started businesses. So that's kind of I guess that was my asymmetric stuff. Some of them bombed, some of them did well. The other thing is it used to be the case, in my opinion, that Bitcoin was a completely asymmetric type bet because a lot of people thought it was going to zero. And I think, before Wall Street got involved, before governments, before Trump said it was going to be part of the reserve, the Treasury Reserve, it was something that could have gone to zero. So I wish in 2009, I was sitting in my daughter's bedroom where the computer was and mining Bitcoin there, making 100 Bitcoin a day or whatever those kids used to do back then. I probably would have lost it anyway. But my point is, take some risks early on. You can afford to lose it especially when you're younger. I would have liked to given myself more of a shot for chasing these sort of life-changing type investments. And you could take 5 to 10% and say, I would have spent this on a Maserati, but instead of doing that, I am going to buy into something that may very well go to zero or could give me, 100x on my return, right? Anyway, that's kind of the other thing that I think I wish I had done more of early on. Speaking of Maseratis, I think I found that buying material thing gives me joy for about a week when I do it. Bought a nice watch a couple times, and boy, it was great for about a week. And the next thing you know, they're in my closet, or like in the case of cars, they're in your garage or whatever. I wish I had used that money to buy more stuff, like more assets, investable assets, more Bitcoin, maybe more real estate, maybe, who knows? Or even just thrown. What's funny is I used to actually own NVIDIA stock back in like 2016. It was weird. I used to read all these newsletters, and some guy convinced me on his newsletter to buy NVIDIA. Well, of course, a year later, it wasn't much different, so I just ended up selling it. I don't know. Anyway, those kinds of things I wish I had taken more seriously and sort of been more consistent about trying to let them come to fruition. Okay, I think you got enough from me on this question. It made me really think kind of some of the things that I did, some of the things that I'm glad I did, some of the things I wish I did differently. But hopefully you've got some direction, and if there were some gaps in what you were thinking about, hopefully it was helpful. I actually obviously went down one heck of a rabbit hole here. So that's why I decided just to stick to this one question. That's it for this episode of Ask Buck. Be right back. You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com. Welcome back, everyone. Hope you enjoyed that episode of Ask Buck One Question, because it was basically like, what do I do with my life? Well, I don't know. Let me think about it. But yeah, I mean, it is a good question. I mean, there's a lot of things to think about when you first start out and, moving through life, and you don't want to just, basically hand off everything to somebody else. And, personal finance, again, I always say is personal. So you should, think about these things, because at the end of the day, you're the one it matters to you more than anybody else. If you are interested in asking me some questions and, potentially get my opinion on things, feel free to go to wealthformula.com and you can certainly record some questions there. Otherwise, you can always just shoot me an email at buck@wealthformula.com. I always check my own email. That's it for me this week. Wealth Formula Podcast. This is Buck Joffrey signing off.